here's why I just decided to invest in a 3x utilities ETF, UTSL, which is down over 55% this year. Utilities tend to do well when three things happen. They're cheaper than the market, interest rates are falling, and the economy is weakening. So let's look at each of these one by one. The first one is easy. We know utilities are cheap right now. Compared to the S&P 500, their forward PE is about as cheap as it's been in the last 20 years. The other two aren't quite as easy, but I also expect rates to fall and the economy to weaken. So far this year, the US economy has been stronger than expected and the 10-year treasury rate has gone higher than expected. Well, let me clarify. Rates went higher than the market expected. It was exactly what I predicted in my video on February 24th. What this yield curve is telling us is that interest rates are expected to fall significantly, by nearly 1% over the next year and even more after that. But I believe the market is overestimating how fast the Fed will cut rates. That would send rates higher in the intermediate part of the yield curve, meaning more downside for bond prices. That's exactly what happened. The red line is where interest rates were on February 24th, when my video came out. And the blue line is where they are today, on October 2nd. You can see that intermediate and long-term rates in the 7 to 30-year parts of the yield curve rose a lot more than short-term rates in the 1 to 3-year part of the yield curve. That's a key reason why utilities have fallen so much this year. Higher rates negatively impact utilities in two ways. First, utilities tend to do a lot of borrowing, and when rates go up, that gets more expensive. Second, higher interest rates can negatively impact their growth. Let's take a renewable energy project, for example. The revenues they'll get from it are based on energy prices years in the future once the project is completed. Those don't change, but the cost of the project goes up a lot when interest rates go up because they have to borrow money to build it. With the costs going up and the revenues staying the same, at some point it just doesn't make sense to take on new projects anymore. So higher rates can impact future growth. I expect interest rates to come down over the next few years and likely sooner because rates are driven by inflation. And inflation is falling. It may not be falling as quickly as everyone hoped or expected, but it is falling. I believe that one way or another, either through falling gradually or through recession, inflation will come back down. Remember, the Fed raises rates to lower inflation. So once inflation goes down to their target, they can stop raising rates and maybe even think about lowering them. I think we're getting closer to that point, and flat to falling interest rates should be good for utilities. The third driver for utilities is the economy, which is closely tied to interest rates. The reason interest rates have gone up this year so much is because the economy has been stronger than expected. A stronger economy means more jobs, higher wage growth, and higher inflation for longer. Thus, interest rates keep going up. Going forward, I think there is a lot of risk that the market is ignoring. Credit is tightening, which makes it harder for consumers and businesses to borrow money. Consumer spending is weakening as people are running out of their excess savings from the stimulus programs. Job openings have been falling, which tends to come before people start getting laid off in a recession. Let me know in the comments if you want me to do a deeper video on why I'm cautious on the US stock market. But for now, those are the main reasons, and the key is that I don't think those risks are priced into the market. Since most utilities are boring, steady, dividend-paying companies, they're known as a defensive sector, meaning they usually do well when the economy is weak. They often act as a counterweight to other parts of the stock market, which do better when the economy is strong. So far this year, everything has gone wrong for utilities. They came in with high valuations, the economy has been stronger than expected, and 10-year interest rates have gone up a lot. Going forward, I think the picture looks really different. Now they're cheap, I expect the economy to weaken, and I expect interest rates to come down. If I'm right, I expect utilities to do really well, especially my 3x leveraged ETF, UTSL. For a lower risk option with no leverage, I might have considered the Vanguard Utilities ETF, VPU. If inflation and interest rates keep going higher, utilities will probably continue to suffer in the near term, but eventually interest rates will win the battle and inflation will come down. One of the top rules in investing is don't fight the Fed. So if my timing's good, that's great. Sometimes it happens. But if I'm early, I'll plan to add to my position on further weakness because inflation and rates will not keep going up forever. And when they fall, that should be good for utilities. By the way, check out my free currency course. It's 10 videos, it's free. Check out the link below in the description and in the first comment. Thanks for watching.